Hey, Bowtie Nation, Joseph Hogue here, coming at you with an emergency update. Had another video planned for today, but the market's selling off like it is, and some market darlings like Palantir down 20% into a bear market already. Thought I'd give you an emergency update because I know a lot of you out there are freaking the fuck out. Yes, there's going to be some bad language words in some of these unscripted videos. It's just the Marine in me coming out, so maybe not NSFW or NFWS. I'm Gen X. I don't know what that acronym means. What I do know, though, is after 25 years of investing and more than 10 years as an analyst, venture capital analyst, what I do know is this is not the time to panic. Okay. I'm going to show you where we're at, what got us into this mess, how bad it could get, and how to invest. First of all, to put this into perspective, the overall market sell-off hasn't been that bad so far. Okay. We're seeing futures down less than 0.1% today after yesterday's sell-off. S&P 500 index there hit its all-time high last Thursday, so down less than 1.3% from that. So not like somebody shit in your lunch and called you Mary. Okay, it is not that bad, folks. Relax. Of course, some of our market darlings here, like Palantir, are worse off. Palantir down at $153 pre-market. Looks like it's going to pass that point. We can see here it hit its all-time high last week as well, and is looking like it's going to be about 20% down from the peak. But think about this: that's only takes you back down to back to the August returns. Okay, so it's basically just wiped out 1 month of gains. Unless you bought in just over the last month, sitting pretty damn well here. One of the catalysts to this is an MIT report went out that 95% of Gen AI pilots, so company pilot programs for AI, are failing. Says that companies have invested between $35 and $40 billion in generative AI, so AI agents, things like that, and they say almost nothing to show for it. I think there's a lot to read into this report. It can be a little misleading, I think, of what they're saying here. It's saying 95% of enterprise organizations have gotten zero return for their AI efforts, and that 5% of organizations have successfully integrated AI tools into production. Now, there's a few things there that I think we should unpack that may not mean what the market is reading into it. Okay, it says only 5% of organizations have successfully integrated AI tools into production. So basically, not that people aren't using AI within that organization to benefit and to increase their profitability and lower their work, but that 5% of those big tools like the agents and the customer service bots and all that kind of stuff that they're using, those AI tools, have been placed into production. I think that's how they're measuring this return on investment. Of course, it also didn't help that OpenAI CEO Sam Altman also said that he does see a bubble forming in AI. So for somebody in the industry to say, yeah, there's kind of a bubble here. And that was kind of a wake-up call for a lot of people, a lot of investors as well. It's the no shit moment of 2025, though, okay, with Palantir trading for 100 times price to sales and some of the other stocks that we'll look at. It is worth reading into what Altman is saying here, okay? He's saying that, yes, we are in a phase where we're overexcited about AI. His opinion is, yes, it is kind of that bubble exuberance phase. Will AI be one of the most important things to happen over the very long term? And he says in that, yes, his opinion is also yes. Okay. So basically, he's just reiterating what we've already known, what we've heard from a lot of other people out there, that AI is going to be transformative. It's going to be like when I started investing in 1999, everybody was so crazy hyper about internet stocks, right? The dot-com bubble that was forming. Yes, it was a bubble. Yes, the market did crash. I'm not saying that's what's going to happen right now, but back then the market crashed. But that doesn't mean that internet still didn't change our lives. Okay, if you had stayed invested in the shares of Amazon, there in 1999, I think it hit something like $20, $30 per share, fell down to less than $1 per share in 2002 in that crash. If you had just held on, holy shit, you would have made a lot of money anyway, even if you had bought in at that very peak there. Okay, so even if this does turn into a crash, which I'm not saying it is, then you're still going to do very well in these AI stocks because this is a transformative moment that we haven't seen for more than 25 years. And again, I know I'm bringing down the wrath of all the Palantir groupies, but you forget I started investing in 1999, okay, at the height of that dot-com bubble. And so I've done all this shit before, twice in fact. In 1999 and in 2008, I got caught up in both of those bubbles because I'm stupid like that, and I just didn't learn yet. I knew stocks were expensive. I knew some of those market darlings like we have now are ridiculous valuations, but I didn't care because the plan was to get rich and sell before the market crashed, sell before everyone else. Well, now the market is falling. So what do you do now? I want they give you a roadmap to where the market is going and what to do. Now, in that, I want to start with where we are. And again, the market is down less than 1.5% from its all time peak. Some of those crashing AI stocks have only taken back the last few weeks of returns. So, earnings were really good. There hasn't been any legitimate bad news, just no good news. And with stocks so expensive, with stocks where they are, you need that constant flow of good news just to support stocks and keep people from taking profits. They're showing you how expensive stocks are. We can see here in these PE ratios. So the price to earnings ratio, that's the price of here the S&P 500. So that broad market index, all 500 stocks in that index, the price of those divided by their earnings, how much investors are paying for every dollar in earnings. It's at 28 times. Okay, that is as high as it was back in the peak of 2024, back in the mad money era of the pandemic, where the government was throwing $7 trillion at the market and inflating those prices. It's as high as it's been ever since the bubble back in 1999. You can see that even at a closer sector level here is just how overheated the market is. Okay, and that's what we're talking about when we talk about how expensive stocks are, these price to earnings ratio and some of these other valuation metrics, how overheated the market is right now. If you look here, we've got the forward price to earnings ratios. Okay, so this is the price of, again, all the stocks in these S&P 500. And here, all the stocks within each sector. Okay, so all the tech stocks together, all the industrial stocks together, all the energy companies together right there over the expected earnings, those forward earnings over the next 12 months. So what do analysts think that those companies in each sector are going to report for their profits over the next 12 months? The price divided by that. Okay, and that's the blue bar, the dark blue bar is the current price to earnings, so the current valuation on these, versus that green bar, which is the 10-year average. Okay, what have investors been willing to pay for these stocks for every dollar in earnings over the past 10 years? That's kind of a benchmark for maybe where they should be. Okay. If times were normal, if the bubble wasn't so inflated, and if stocks weren't so overheated, how much would investors be typically willing to pay for these? And we can see with something like information technology. So those high-flying tech stocks, they're trading for 30 times on a price to earnings basis. The 10-year average of 22 times. Okay, that is 36% more than that long-term average. Okay, so 36% premium, 36% more expensive than their average. And you look across here, nearly every single sector, stocks in nearly every single sector are more expensive than what investors have been trading for them in the past. A very overheated market. You can see really only two sectors here on the right, healthcare and energy, trading cheaply compared to those long-term averages. And again, nothing new. This is what we've been following. In fact, it's exactly what I warned about on July 21st when I said the market correction was coming within 28 days. And well, I was 2 days off, okay? I pointed out weakening data, investor sentiment, and just recommended a shift to some of those safer sectors like healthcare and utilities. And we do see those two sectors are now up 3.7% and 2.7% in the last month. That's against the sell-off in tech, just barely positive here. We've got 4 of the sectors, 4 of the 11 sectors down over the last month, and the S&P 500 up just 1.8%. So shifting to those healthier, those safer sectors has helped protect your money there. And if we step back here, fortunately, just about everything outside of that AI worry still looks good, and there's a mountain of support coming for stocks. The CME Fed Watch tool, that's a tool that we use to follow what the market expects rates to do. They show you the Fed meetings over the next year. We can see here in September for the next meeting, September 17th, the market does expect 85% odds that the Fed will cut its interest rate by 0.25%. Okay, that's pretty much penciled in at this point. But if we go here to the probabilities on that, we can see all the meetings over the next year and the market odds of a cut in each one. Okay, so the blue boxes here are the highest probability for each. We can see here in September, the market does expect a rate cut of 0.25% from that 425 to 450 target right now. We can see the market expects another cut here in October, maybe not one in December. So still two cuts here this year, and then another 3 cuts there next year. Now, President Trump has already nominated Stephen Barron as a Fed governor to replace the one empty seat coming up. He's going to pick the next chair next year when Chair Powell's term ends as chairperson there. He's going to be putting a ton of pressure on the Fed. We already know that a few of the Fed members wanted to cut last time, were overruled by the majority of them, but he's going to have that new Fed governor. He's going to have a new chair. He's going to have to be putting a tremendous amount of pressure on the Fed to cut further. And honestly, without inflation spiking. Okay, yes, inflation is up over the last couple of months, but it's, 2.5, 3%, even up to 3.5%. With that memory of the 9% inflation back in 2021, 3%, 3.5% doesn't seem that bad. So I don't think it gives the Fed quite enough ammunition to really deny making those Fed rate cuts that the market already expects. So you've got, two coming this year, three coming next year. That is five rate cuts. That is more than a percent at least of interest rate cuts. And if there's one rule in investing, folks, it is that you don't fight the Fed. Okay, you don't be betting against the market when the Fed is cutting rates and supporting stocks. We're wrapping up second quarter earnings reports, and earnings profits were very good with almost 12% growth in the last quarter. Even the slowdown here with analysts projecting 7.2% earnings growth year over year for the third quarter, 7% for fourth quarter. Even with that slowdown, earnings profit growth is still really good. So in all likelihood, what we have here with the upside to the fundamentals, the Fed rate cuts coming, very likely this is just a normal correction, even if that, okay, if the market doesn't almost immediately rebound, it's only down about 1.33% right now. But if it doesn't rebound, if it still heads further, probably only looking at a normal correction here. So data going back to 1980, so almost 4 decades of market data here. The data by Visual Capitalist Graphic shows 36 times the market has fallen more than 10% in the past 4 decades. It's only become a bear market of 20% or worse about 5 times of those. Okay, so 36 times the market has fallen more than 10%. Actually, the market falls more than about 5% almost every single year. Okay, we get those market corrections almost every single year. We've already gotten one back there in April with the Liberation Day sell-off. But these kinds of light market corrections happen almost every single year, and they turn into a quick buying opportunity. And that's because on average, these have only lasted 71 days. Okay, that is less than 3 months from the top, from the all-time high, so which would have been last week, only 71 days until the bottom of that. So, okay, if you're buying on the way down, I'm going to show you how to do that and at what points to buy in a little bit here. But it's only a 2-month wait until stocks head higher again. Okay, again, typically from 1980 to the 2018 study period here, we've seen one correction. They're defining corrections as 10% or more. So, even more than that 5% that we normally think about a correction. They're saying one correction per year, decline in stocks of average around 15% on total. Now, of course, even a more modest 5% correction is going to feel a lot worse for a lot of tech investors because those stocks, especially the AI stocks like Palantir, like AMD, like NVIDIA, they're already so overbought on the short term that they're going to sink further than the market. So I want to show you a few ideas on how to invest, how to ride this sell-off out to higher prices later. And of course, the first thing you can always do is just do nothing and just sit tight. Okay, if you have longer than 5 years to needing your money, even if a sell-off does get worse, even in a stock market crash, stocks are going to be higher 5 years from now. That's because, again, the fundamentals of this market are still very good. We still have that strong earnings growth. We got capital spending on AI and data centers, and the hardware theme is not slowing down. $365 billion just from the hyperscalers that going into that theme that's going to support tech stocks, going to support AI stocks, and that investor sentiment, along with a president that measures his dick size by how much the stock market goes up or down. So if the stock market falls further, Trump is going to do everything he can, legal and maybe not so much, to prop up stocks. Now, if you do have a shorter horizon than 5 years, so you're going to need that money within 5 years, or you're just getting a little nervous, okay, there is still time to de-risk because the market, again, is not down that much. And even the AI stocks. So what, you give back a month worth of returns. There is still time to de-risk, get into some of these other sectors like healthcare, like utilities, like energy. All three of those sectors are going to protect your money. They're good cash flow sectors. I'm going to look in some of these sectors, what you can do. These are all the stocks in those sectors within the S&P 500. So if you go here, you click on these, open them up, you see things like Baker Hughes, which we recommended just last week, ConocoPhillips, Devon Energy, one of my favorite energy stocks there, Chevron Energy, right next to each other. Devon and Chevron are two that I really like there. You've got healthcare stocks. We just highlighted NVO, Novo Nordisk, just this week. We've got Humana there, another one of my favorite stocks, Medicare Advantage stocks there, Humana, ticker HUM. We've got medical device, MDT, okay, another very good stock in the healthcare space. All the stocks in the healthcare space, utilities, energy, going to hold up relatively well if the market sell-off does get worse. But for any stock, you can use option strategies to de-risk, to take some of the risk off the table, to cash flow that investment, and even lock in returns on the downside. So if we go here to Palantir, to the options available, we'll use I would recommend using a little bit further out, maybe maybe even the January 2026 options. We'll look at those as an example. You want to play around with this, play around with the dates and the strike prices that you use. But with Palantir, right at around 160 right now. Got the calls on the left, puts on the right. Here we go down to the money ones. Now you can sell a $155 strike for $25.60. Okay, that is going to give you 25.6 divided by 160. That's a 16%, a 16% cash return on the shares right now. Yeah, of course, yeah, it does cut some of your upside return because you commit to selling those for $155 through January of 2026 there through that expiration. But that is a 16% cash protection there. If Palantir does continue to falls under 155, you're going to keep that 16%, plus you're going to keep the shares. Okay, so you just reduced your risk by 16%. You could also buy a put option. Okay, if you buy the puts here at 155, $20 each. Okay, now you are locking in the price of 155 if the stock falls further. Okay, so if the stock just craters to 140, 110, $100 per share, you can still sell it for 155, and it's only going to cost you $20 to do that. Okay, so this is just a way to, either de-risk, take some of the cash, take some of your money off the table, but keep the stock, or lock in a lowest price, lock in a floor of price for the stock. Now, above all, what you do not want to do is you don't want to chase this market every day lower. Okay, you don't want to be buying into stocks every single day on the dip, thinking that, okay, this is the last day of dips to buy. You're going to jump in and you're going to put all your money in there. Basically, you're just going to run out of money. If this market does fall, that modest 5% correction, or maybe even worse, 10%, you're going to run out of money to invest within 2 or 3% downside, and you're not going to have that opportunity to buy in at the really good prices. So what you want to do, you want to plan out points in the market or in a stock, in Palantir or whatever stock you might be looking at. You want to plan in points where you're going to buy in at. Okay, so if we're looking at the market here, the S&P 500 index right now about 64.11, down from that high of about 64.80. I'd say, I'd give the market another 1.5%. Okay, if it does fall another 1.5%, that would be about 3% from its high. That would probably put it, well, let's do the math here. If it was at 64.80 times 0.97, about 62.85. Okay, so if the market falls, if the S&P 500 falls below 6,300, then I would start buying in. Okay, so I would buy in maybe on that day that it hit that 3%. Then I would wait until it's 5% down lower. Okay, so so we got 64.80 times 0.95, that would be 5% down. If the market falls further to 61.50, okay, on that S&P 500 index, then I would buy in again. Okay, I would push a little bit more money into the stocks that I really like over the long term, taking advantage of that buying opportunity. Okay, then I would wait for further, wait for maybe 7%, 8, 9% down to invest further. Okay, do not be jumping in every single day on these little tiny dips, because you're going to run out of money and you're going to miss the chance to buy in all the way on that opportunity on the full correction. If you want to see exactly what's in my portfolio and see the stocks I'm buying, join me on the Blossom Investing app, free with the invite link in the description below. Don't miss upcoming news on our New York and Chicago meetups. Going to be very first Let's Talk Money meetups. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.